Hello, good evening, all. Please confirm you can hear me clearly.
Good evening, sir.
Okay, Femi Balogu, good evening. All right, you can
Good
mute.
evening, sir.
Thank you. Now the class is scheduled to start for 8:30. We have like 2 minutes more, so we are going to wait for like 2 minutes. So we are going to wait so that we start the class at exactly 8:30. While we are waiting for others to join, let me say that the subject strategic financial management, contrary to students' opinion, is not as tough as the impression created by students. The paper or the subject, strategic financial management, is not as tough as the impression created by students. However, the syllabus you are expected to cover is wide. And within 3 to 4 months, you are expected to read a lot. What am I trying to say? Is that it is advisable for you far. It is good to start your preparation now. All right? We go to this class fully. Our topic tonight is capital structure. Our topic tonight is capital structure. Just one minute. Somebody is asking for the link again. This distraction. When we are having class, you are not asking for a link. Right, let's go. Let us do an overview of strategic financial management. What is financial management? Or what is strategic financial management? Financial management is that component of management. It's an integral part of company's management. Strategic financial management is a major aspect of company's management that focuses on the financial affairs of the primary focus of strategic financial management is the financial affairs of the business. You can also define strategic financial management as a management at the highest level. A management at the highest level that is concerned with how companies source finance, how you can source finance, how you can raise finance, how company can utilize finance efficiently and effectively so as to achieve the objective of a business organization. Look at that summary. Strategic financial management is concerned with how companies source finances, how you can generate finance. That means you must understand the various types of finance, the various sources of finance. When you source finance, you must know how to utilize finance. One thing is to have money. The other thing is to know how to invest money in an efficient and so as to achieve the corporate objective of the organization. What is the corporate objective? It is assumed that the primary objective of a business entity is to maximize the wealth of the shareholders. Companies are in business so as to create value for the owners of the business. The owners of the business are the shareholders. So companies are in business to create wealth for the shareholders. Look at it. Look at the overview. How you can source capital. How you can utilize capital. How you can invest capital so as to meet the objective of a business entity. At every point in time, watch out. All the topics you are going to be doing under strategic financial management, we always reflect that definition. If you are carrying out investment appraisal, you are trying to evaluate the financial viability, the financial profitability of a business. If the business is profitable, that will increase the wealth. If you are trying to source finance, you are going to ask yourself, if I source finance, I can either use equity financing or debt financing. If I use equity finance, what is the impact on the shareholders' wealth? If I use debt finance, what is the impact on the shareholders' wealth? At every point in time, all the topics you are going to be seeing, we always reflect the definition of strategic financial management. I'm going to explain that. We now move to the first topic today. Our topic today, capital structure and theories of gearing. All right, introduction to that topic. What is capital? Assuming you are asked as a finance person, what do you understand by capital? Let's expand this. All right. You can define capital as money used to create a business, money used to build a business, money used to run a business. Capital can be defined as money used to create, build, and run a business. If you are to start a business, you are going to require capital. That is the money used to create your business. If you want to expand your business, if you want to build your business, you are going to require additional capital. Also, on a daily basis, the money you use to run your business is part of your capital. So if you are to define capital in a very simple and comprehensive way, this is the money used to create a business, to build a business, and to run a business. Next, types of capital. Basically, there are two types of capital. Basically, there are two types of capital. One, equity capital, and two, debt capital. Equity capital. This is the capital contributed to the business by the owners of the business. Equity capital. This is the capital contributed to the business by the owners of the business. The owners of the business are the shareholders. So equity capital represents shareholders' contribution to the business. Number two, debt capital. Debt capital. This refers to all debt. The debt capital refers to all form of borrowing. That is the amount the companies borrow to run its business. All right? We have explained what is capital. We have explained types of capital. Our next discussion. What is capital structure? What is capital structure? Capital structure is the mix of equity and debt capital used by a company to finance its activity. Capital structure. This is the mixture of equity and debt capital. This is the mixture. This is the proportion of equity and debt capital used by a company to finance its business activities. The capital structure may include long-term loan, medium and long-term loan. This may include ordinary share capital, reserves, and long-term borrowing in the form of debentures. The capital structure may include the ordinary share capital, the preference share capital, equity reserves, long-term borrowings in the form of debentures. This shows the different types of capital the company uses to finance its activities. Now, clear, please. Your capital structure shows the different types of capital used by a company to finance its business activity. All right. A company may be financed by equity capital. A company may be financed by equity capital or debt capital, or a combination of equity and debt capital. You can finance your business with equity, your personal money. You can finance your business with borrowing, debt, or you can use a combination of equity and debt. If a company is financed by equity capital only, if a company is financed by equity capital only, such company is classified as ungeared. Look at it here. Such company is classified as ungeared. If you finance your business with your own money only, your company will be classified as ungeared. Alternatively, if a company is financed by a mixture of equity and debt capital, alternatively, if a company is financed by a mix of equity and debt capital, such company is known as geared company. Please be noting this. Your company may be geared or ungeared. A company may be geared or ungeared. All right. We have explained what is capital. We have explained types of capital. We have defined capital structure, and we have explained what is capital structure. Our next discussion, risk and diversification. What is risk? Why should we pay attention to risk? If you finance your business with equity, what is the risk involved? If you finance your business with debt, what is the risk involved? If you finance your business with a combination of equity and debt capital, what is the risk involved? This class, by God's mercy, you are going to pass. But beyond passing, you must be able to stand that, yes, I understand this concept. Risk. Risk can be defined. The risk in an investment or portfolio of investments. We can define risk as the variability in expected return. When we say risk, variability in expected returns. You can define risk as volatility in expected return. What we call risk is when you are not sure, if you invest your money and you are not sure of the amount of return you are going to get, the return is always fluctuating. The return is very volatile. Your investment return is very volatile. In that case, we said there is risk. If you look at investment in equity, share price can fluctuate. The investment value can fluctuate. That is why equity investment is very risky. If you invest your money in equity today, tomorrow the share price may fall. And if the share price is falling, your investment value is falling. Next tomorrow, the share price may rise. That means that investment is risky. You can classify risk into two for the purpose of capital structure discussion. We can classify risk into two. One is the business risk. The second is the financial risk. What is business risk? This is the variability in the firm's operating profits. Our business risk. This is the fluctuation, the volatility, the variability of the firm's operating income, variability of the firm's profits before interest and tax, where the operating income of the business is fluctuating. Your business risk is the variability in return that is associated with the nature of the business and the industry sector in which the firm operates. Your business risk. This is the variability in returns, variability in profits, variability in income that is associated with the nature of the business and the industry sector in which the firm operates. When you say business risk has to do with the nature of your business. The business risk. This is the risk that a company may achieve low profits. The business risk. The risk that a company may achieve low profits or the company may incur losses due to the nature of the company's business. Due to the nature of the company's business. For example, please note, all businesses have their individual business risk. If you look at the banking business, we have risk peculiar to the banking industry. If you operate a bank and you are giving out loans, there is the risk of customer defaults. You can advance loan to a customer and the customer fails to pay back. This is peculiar to banking. If you look at manufacturing business, we have manufacturing business risk. For example, if you are into bakery business, the nature of your products is highly perishable. If you bake a bread today, within 2 days, within the first and second day, you must make sales. Otherwise, in the third day, no customer is willing to buy that bread. It becomes stale. So when you are talking of business risk that a company may achieve low profits, or the company may incur losses as a result of the nature of the company's business. Number two, financial risk. The financial risk. This is the additional variability in returns to shareholders. This is additional variability in returns to shareholders that arises because the capital structure contains element of debt capital. Financial risk. Additional variability in returns to the shareholders that arises because the company uses debt capital in its capital structure. In other words, financial risk is purely associated with debt finance. Financial risk is purely associated with debt capital. Company will only talk of financial risk because the company has borrowed money. Company will only be exposed to financial risk only because the company has borrowed money. If a company is financed by equity capital only, the financial risk will be zero. That company will not have financial risk. Right? Please note this. If you check our last diet, larger percentage of the question is or are in theories. So as much as possible, let us try to understand why we listen. Right? We have explained risk and the classification of risk. Our next discussion, gearing. What is gearing? What is the meaning of gearing? Gearing can be defined as the amount of debt capital a company uses relative to its equity capital. Your gearing. It is the ratio of the debt capital to equity capital. When you say gearing, you are trying to measure the extent to which a company has borrowed money. Your gearing percentage, also called leverage. You can call it leverage percentage, or you call it gearing. The extent to which a company has borrowed money to finance its business. That is the meaning of gearing. There are two types of gearing. Let's go to this gearing ratio. There are two types of gearing. We have financial gearing and you have operating gearing. There are two types of gearing. You can have operating gearing. That's number one. Number two is financial gearing. Financial gearing is used to measure the level of financial risk. Financial gearing, please note. financial gearing is used to measure the amount of financial risk a company is exposed to. Financial gearing is used to measure the level or the amount of financial risk the company is exposed to. The financial gearing measures relationship between shareholders' fund and long-term debt. We also call it prior charge debt. Let me simplify this. Financial gearing measures relationship between the shareholders' fund and long-term debt capital. It indicates the degree or the extent to which the company's activities are funded by borrowed funds. Your financial gearing shows the extent, the degree to which the company's activities are financed by borrowed funds. Number 2, operating gearing. Operating gearing is used to measure the amount of business risk. Operating gearing is used to measure the amount of business risk. It measures relationship between contribution and earnings before interest and tax. Your operating gearing measures relationship between contribution and earnings before interest and tax. The operating gearing indicates the degree to which the company's profits are made up of variable costs. Your operating gearing indicates the extent, the degree to which the company's profits are made up of variable costs as opposed to fixed costs. Let me explain that. If your business has larger amount of fixed costs, that business is at risk because the fixed cost, that cost must be met. When we say fixed cost, whether we produce or we don't produce, fixed cost is incurred. If the fixed cost is high, that business is not likely to make profits. We are only going to incur variable costs if we produce. You can use this ratio, the operating gain ratio, to measure your business risk. All right. We have spent 30 minutes explaining. We have explained what is capital, types of capital, what is capital structure, We explain risk. We explain business risk and financial risk. We equally explain how you can measure your business risk. You can use operating gearing to measure business risk. We also explain how you can measure financial risk. You can use your financial gearing to measure your financial risk. Our next discussion, calculation of financial gearing. How can we calculate financial gearing? Please note, financial gearing can be calculated using the book value approach or the market value approach. Please note, financial gearing can be calculated using the book value approach. Your book value is financial statement of financial position value. Your book value is your statement of financial position values. You can calculate financial gearing using the book value approach, or you can use market value approach. If you are to use book value approach, the formula is you can use book value of long-term debt divided by the equity capital. When we say book value, that is the amount stated in the balance sheet, the value as stated in the statement of financial position. Your equity value, equity capital value, book value, that is your ordinary share capital plus reserves. You can calculate gearing that. Of course, you calculate in percentage, multiply by 100. Gearing is calculated in percentage. This is always in percentage, so you multiply by 100. You can use method 1, or you can use method 2. Your financial gearing is equal to book value of long-term debt divided by equity value plus the book value of long-term debt. Either of the two formula can be used to calculate financial gearing using the book value approach. In most cases, examiner will specify which of the formula to use. In most cases, the examiner will specify which of the formula you should use. But where the examiner is silent, you are at liberty to use any of the formula. All right? Calculation of financial gearing using market value approach. Calculation of financial gearing using the market value approach. You can calculate as 1, market value of long-term debt over market value of equity. Market value of long-term debt over market value of equity. I'm sure we are still going to calculate. Or you can use, no, let me simplify this. At times, students get confused with prior charge. Let's use long-term debt. At times, students get confused with long-term debt. So we're trying to simplify this. Market value of long-term debt. You can use either the Formula 1 or you use Formula 2. Always remember, you are going to multiply your final answer by 100 so as to get a percentage. All right, before we ask question, significance of financial gearing. What is the importance of financial gearing? Why should investors, shareholders, financial analysts, look at it. Why should the company, the shareholders and investors and financial analysts and the lenders, why should we pay attention to financial gearing? Why must these stakeholders, the different stakeholders, the shareholders and investors, must pay attention to the financial gearing of the company? The company's management must pay attention to the financial gearing. The lenders must pay attention to the financial gearing. Why? Financial gearing is an attempt to quantify the degree of risk involved in holding equity shares in the company. The financial gearing is an attempt to quantify the degree of risk involved in holding equity shares in a company. You have equity shares in First Bank. The financial gearing shows the degree of risk involved in holding equity shares in a company, both in the terms of company's ability to remain in business. It measures the ability of a company to remain in business. Solvency. That is solvency ratio. It measures the ability of a company to remain in business and the ability of a company to pay dividend to shareholders. Financial gearing is a very important ratio. The financial gearing will tell us the ability of a company to continue in business. That financial gearing will tell us the ability of the company to pay returns to the investors in terms of expected dividends. The more geared the company is, that is, if the company borrows too much money, if the company is highly geared, the greater the risk that little will be available, little or nothing will be available for distribution to the shareholders. If a company borrows too much money, that means the company is highly geared. The company is more geared. There is a greater risk that that company we have little, if any, available for distribution to the ordinary shareholders. This is because the company must pay interest to the debt holder first. The company must continue to pay interest to the debt holder. And the company must settle preference share dividends. Regardless of the company's profit, the company must meet interest payments. The company must meet preference share dividend payments. So if a company is highly geared, there's a risk that the owners of the company may not get any returns. A high financial gearing means that the company is more vulnerable to poor trading conditions. When a company is highly geared, there is greater volatility of earnings. That is, there is greater risk to the shareholders. This is the main financial risk with high borrowing. The main risk with high borrowing is that if you borrow money too much, you might not have returns to pay to the shareholders. That means a company must know the level of borrowing to maintain. A company must be able to define the level of gearing to maintain. Ultimately, gearing measures the company's ability to remain in business. A high-geared company has a large amount of interest to pay annually. If your company is highly geared, that means your interest payment will be very high. If those borrowing are secured, if the debt is secured in any way, then the debt holders are perfectly entitled to force the company to realize its assets. The lenders can force the company into liquidation. If the company fails to pay the interest as at when due, so you begin to understand the significance of financial gearing. Right. I'll come back to this. I'll come back to Peter. No? Please just hold on. Any question, please? Any question, any clarification? Question, clarification. All right. No question. Please feel free to ask your question. It's usually an interactive class.
Hello,
Always
sir.
remember that although we are having online class, you also have a right. You have a right to make the class, to pause the class and ask your question. that enable the lecturer to explain further. So please, we are encouraged to feel free to ask our question. Yes, Jeremiah.
Yes, good evening, sir.
Yes,
Well
sir.
done, sir. So actually, it's not a question I want to ask. So, actually, I noticed that the material that is in the WhatsApp group is different from this material to some extent. So, please, I don't know if you can get this one too after the class.
Of course, you are going to get it after the class. Yes, not that
Okay, sir.
there are some addition here.
Yes, sir.
Yeah, there's, I agree
Yes,
with that. There are
yes.
some addition here. Over
You
time, we
understand?
also look at it that there might be need to update in the course of the lecture. Where we find that there's need, we add to it. Of course, definitely after the class, whether you ask or not, the material will be shared with everybody. So once you are on the platform, you shall get the material. Is that clear, sir?
Yes, sir.
All right, thanks for the observation.
Hello, sir.
Please, just 1 minute. Okay, please go ahead.
Okay, yeah. For a highly geared company, does for a company to be highly geared, does it have effect on the what's it called, the rate of return? Like, does it make the rate of return for preference shareholders and another ordinary shareholder? Like when there is a new what's it called, share option, does it increase the the return on their investment, or it reduces it?
Okay, we need to break down your question so that we are on the same page. Is that clear?
Yes, sir.
Up to the point you mentioned that when the company is highly geared, will it affect returns? Returns to who now?
To the investors, like preference shareholders and for preference shareholders.
Okay, let's now take it. If a company is highly geared, that means you have a lot of debt in your capital structure. It means your interest payment will be high. Now remember, if you prepare income statement, you are going to start with your revenue. You less your operating costs. You now have profit before interest and tax. You now deduct your interest, is that not? That means before you can pay preference shareholders, you are going to settle interest payment to the debt holders. So if the debt is high, the interest payment will be high, the profit before tax will be low. Is that not? Are you there?
Yes, sir. My question is about a new investor. Like if they push out an option for preference share for people to buy, to invest into the company. Does, like, for a highly geared company, will the interest be more than a company that is not as geared as that is not highly geared? So that's what I mean. I mean, for new investors.
Shareholder, is that not?
Exactly.
The interest to the preference shareholder is fixed. It's a fixed, sorry. The dividend to the preference shareholder is a fixed percentage. Is that clear?
Yes, sir.
So when a company is highly geared, it may not affect the preference shareholder because the preference shareholder also have a fixed dividend. But it can also affect preference shareholder because if there is no profit in a particular year, maybe because the debt is high, the interest payment is high. Now, the profit remaining is now low. Now calculate preference dividend that is fixed. The preference dividend is now more than the available profit. That means that particular year, we might not be able to meet preference share dividends. But the advantage of preference share is that the dividend can be cumulative. If in a particular year, you don't have enough profit to pay preference share dividend, that is fees, you can carry it forward to next year. That is the benefit to preference shareholder. If in a particular year, the fees dividends cannot be met because the profit is low. The profit is low because the company is highly geared. The company must pay interest to the debt holder first. Out of the profit, we have paid out large interest. We are now left with low profit. This low profit is not sufficient to pay the preference dividends. That means that particular year, just 1 minute. Please, just 1 minute. I need to, let me pause this. I'll be back, all right? Yeah, let's go on with the class. I just have to quickly put on my laptop is showing that it's going low.
All right, so welcome back.
So what am I trying to explain is, first, for a highly geared company, preference dividend will not be affected because the preference dividend is fixed and it must be paid. However, if in a particular year, there is not enough profit to pay preference dividends, that will be carried forward, cumulative, to next financial year. Is that better, please? Hope you can hear me.
Yes, sir, we can hear you, sir.
All right, great.
Yes, I hear you.
Now, calculating operating gearing. We have done this now. How can we calculate? Remember operating gearing. Operating gearing is used to measure the amount of business risk. How can we calculate this? Let me bring this here. It's better here, so that we align. I'll come back to this. Let me place this here. Yeah, you're operating gearing. You're not going to sleep. Operating gearing can be calculated as contribution over profit before interest and tax. You can use this approach, or you can calculate your operating gearing as total fixed cost, divided by the total cost, divided by the total cost. We can also use this approach. Let us give you all the possibility. Or you can calculate operating gearing. As total fixed cost divided by total variable cost. Total variable cost. Any of the three formula can be used to calculate operating gearing. Remember, this is used. Operating gearing is used to measure the level of your level of business risk, the amount of business risk. All right. What next? So we have explained this. Like we said, financial gearing is major. Financial gearing. Why are we saying this? It's because regardless of your nature of business, you are going to have business risk. If you choose manufacturing business, there's a risk. If you choose banking business, there's a risk. If you choose construction business, there's a risk. However, you might not have financial risk if you don't borrow money. And the reality is that most companies use borrowing. Borrowing comes with a greater risk. That greater risk, management must monitor it. The life of a business can be easily terminated as a result of borrowing. That is why attention must be given to your financial gearing. Your financial gearing measures your solvency level. Ability to continue and remain in business, and you are still making profits. Remember, we said your financial gearing, you can calculate using market value approach, or you can use book value approach. Please note, financial gearing should be calculated using the market value approach, unless the examiner states otherwise. Financial gearing should be calculated using the market value approach, unless the examiner states otherwise. What are the benefits? If you calculate using book value approach, what are the limitations? What are the benefits? Book value approach uses outdated valuation. It uses historical value. This historical value may not reflect the current market valuation. The book value approach may misrepresent the level of leverage. The book value approach may misrepresent true leverage. The book value approach ignores market expectation. The book value approach ignores market expectation. It does not capture investors' perception or risk. These are the limitations of book value approach. What are the benefits? Benefit of calculating gearing using book value approach. One is, it is very simple and it is consistent with accounting standard. The book value approach is simple to calculate. It is easy to calculate. And it is consistent with accounting. I want to place this here. Like if you are reading the notes, you can see it closer. What are the limitations of market value approach? What are the benefits of market value approach? Market value gearing reflects current economic reality of the business. It reflects the current economic reality of the business. The market value approach incorporates investors' expectation. It incorporates the current investors' expectation, the current share price, and the current debt price. So it's more realistic. The book value approach gives a more accurate view of the company's economic leverage. The book value approach gives a more realistic view of the company's economic leverage. What are the limitations of book value approach? One, volatility. Market prices fluctuate on a daily basis. The market value is not constant. It's always fluctuates. This market price may be driven by temporary sentiments. Market value approach is vulnerable to market distortions, particularly if the shares are thinly traded. If the shares are not actively traded, that is thinly. These are the limitations. Now, please note, for some of us that we took class diet exam, you observe that most of the questions are in theory. For those students that prepare for theory very well, they were able to skate through. What am I trying to stress here? We have explained how to calculate both the market value approach and the book value approach. We also explained the advantages and disadvantages of the market value approach and the book value approach. The examiner can choose to ask you any question, whether theories or calculations. So let no student be caught unaware. Let nobody be caught off guard. All right. What next? Let us discuss beta factor. Why is this important to us? This topic we are taking, capital structure, is related to cost of capital calculation. This particular topic that we are discussing today is related to cost of capital computation. And we have what we call beta factor, your beta value. You are still going to see this more. Your beta factor or beta value is an index that measures level of risk. Your beta factor or your beta value is an index that measures the level of risk, the level of systematic risk. Risk that cannot be avoided. You are still going to do this more when you get to portfolio theory. This beta factor, we have like 3 times or 2 times. Take it 3. You have equity beta. That is beta of equity. It's also called geared beta. Your equity beta, you can also call it beta of equity, or you can call it geared beta. It's a beta factor that measures the market risk of a geared company. The equity beta is a beta factor that measures the market risk of a company, considering both the business risk and the financial risk. I will take that again. And I believe that with time it's going to get clearer. Your equity beta measures the market risk by taking into consideration both the business risk and the financial risk. For you to have business risk and financial risk, that company must be geared. For you to have business risk and you have financial risk, it means your company is geared. You can calculate your equity beta with this formula. Beta of equity is equal to beta of assets plus bracket beta of assets minus beta of debt bracket close bracket multiplied by value of debt over value of equity multiplied by 1 minus the tax rate. You can use that to calculate your equity beta. Your equity beta represents both the business risk and the financial risk. We have asset beta. Also known as ungeared beta. Your asset beta. Also called ungeared beta. It is the beta that measures the market risk of a company without considering the impact of the debt. It is the beta that measures the market risk of a company without considering the impact of the debt. Please note, your asset beta only consider the business risk. It is the beta factor that measures the market risk of a company by considering only the business risk without considering the financial risk. That is asset beta. If you are to calculate asset beta, you can use this formula. Beta of assets is equal to beta of equity multiplied by value of equity over value of equity plus value of debt into bracket 1 minus the tax rate plus beta of debt multiplied by value of debt into bracket 1 minus tax rate divided by value of equity plus value of debt into bracket 1 minus tax rate. You are still going to see more of this. Lastly, we have debt beta, beta of debt. The debt beta is a measure of the sensitivity of equity to changes in debt capital. The debt beta is a measure of the sensitivity of equity to changes in debt financing. That is, if you borrow more money, what is the impact on equity? If you reduce your borrowing, what is the impact on equity? It is derived from the ratio of credit spread to equity risk premium. It is calculated as the ratio of the credit spread to the equity premium, equity risk premium. The debt beta is often assumed to be zero. Factors that influence beta factor, beta value. If you check last diet, examiner asks, I think last diet, examiner says, or upper diet, examiner says, what are the factors that determine equity beta? Explain the factors that determine the equity beta of a company. Your beta factor, when you say equity beta, what are the factors that determine level of business risk and financial risk? That's what the examiner is asking you. What are the factors that determine your business risk? What are the factors that determine your financial risk? Remember we said beta factor is an index that measures risk. And we have two types of risk. We have the business risk. We have the financial risk. So if you are asked, what are the factors that influence beta factor? What the examiner is asking you indirectly is that, what are the factors that determine risk? One of them is the nature of your business. The nature of your business will determine your risk. That is the industry sector where you operate. Number two, the financial leverage. That is the extent to which a company has borrowed money. The higher the debt, the higher the beta factor. Your beta factor is an index that measures risk. The more you borrow money, the more risk you are exposed to. Hence, the higher your beta factor. Number three factor, the operating leverage. Your operating leverage is your operating gearing. That is changes in earnings before interest and tax. To what extent is our operating profit fluctuating? What is the change in the earnings before interest and tax because of the asset management? Your operating leverage, your operating gear, please remember, leverage is also called gearing. Please remember, leverage is also called gearing. Your operating leverage measures your business risk. The higher the operating leverage, the higher the risk, the higher the beta factor. If your operating profit is fluctuating too much, that means your beta factor will be high. Number 4, the choice of the market index used in calculating the beta factor. Please, you are going to read this. And finally, the time period or frequency used to calculate the beta. These are the factors that can affect your beta value. What next? Before we go into that, I want to bring in addition to this discussion. Yeah, let's discuss this. This will help the class too. If you look at last diets, we are still going to treat the question anyway. Last diet, 2 questions was texted from capital structure. Question number 4, capital structure question. Question number 5, capital structure. The examiner was bent last diet on texting capital structure. Our next discussion. What are the factors that determine company's capital structure? What are the factors that can determine a company capital structure? What are the factors that determine how you finance your business? Should I finance my business with equity or with debt or with equity and debt? You want to discuss factors affecting capital structure. What are these factors? Number 1 factor that can affect your capital structure. Number 1, nature of your business. If your business is capital intensive, like oil and gas, like shipping business, if your business is capital intensive, you are likely to require both equity capital and debt capital. In fact, you are likely to use more of debt. So nature of your business We determine your capital structure. We affect your capital structure. Number 2, size of the business. If the company is big, if the company is large, it can easily obtain debt capital at a lower rate. The size of your business. If the size of your business is very big, you can easily obtain borrowings at a reduced cost. But small firms will rely on equity capital. That is owner's wealth, owner's money. That is number 2 factor that can determine or that can affect the choice of capital structure. We are looking at those factors that can affect the choice of a company capital structure. Nature of your business, size of your business. Number 3, earnings capacity, earnings stability. If a company has a stable cash flow, if a company has a stable income, it can afford to take more debt finance. If a company has a stable income, if you have a stable cash flow, that company can afford to borrow more money. But if the company's earnings is volatile, if a company's earnings, a company's income, a company cash flow is volatile, that company will rely on equity finance. So any stability can affect the choice of capital structure. Number 4, growth potential, the growth rate. High growth companies require a lot of capital fast. Hence, they often use debt capital. If that company is experiencing growth, it will require more capital, which can be obtained from borrowing. So your growth potential will affect your choice of capital structure decision. Number 5, cost of capital, the cost of fund. Generally, debt capital is cheaper than equity capital. Hence, to minimize costs, to reduce cost of capital, it is better to use debt capital. Tax shield, that is tax relief on interest payments, makes debt capital attractive. So number 5 is cost of capital. Number 6, cash flow position. The company cash flow position. Strong, predictable cash flow position supports higher debt servicing. Meaning that if you have a strong and predictable cash flow, you can rely on debt finance. Number 7, asset structure. Firms with tangible assets such as land, crane, machinery, buildings, properties can borrow more money. If your firm has tangible assets, the tangible assets can be used as collateral for borrowing. But service firm with intangible assets, service firm like equity professional now, we render services. With few assets, we rely more on equity financing. Point number 8, interest rates. That is the cost of borrowing. If interest rate is low, a company may be encouraged to borrow more money. Number 9 factor that can affect your capital structure decision is capital market conditions. Capital market conditions. If the stock market is booming, then it is better to issue equity. If the stock market is experiencing boom, we can take advantage and issue more shares. That will increase our equity value in our capital structure. So capital market conditions can affect the choice of capital structure. Number 10, inflation. High inflation erodes debt value. If there's inflation, value of debt becomes cheaper. Debt instruments become cheaper. So firm can choose to borrow more, although lenders are likely to charge higher rates. Control and risk factors. Ownership and control factor. If you are trying to avoid dilution in ownership, if a company is trying to avoid dilution in ownership, it is better to finance your business with debt. Owners want to keep control. If the owners want to keep control to themselves, they will prefer debt capital. So the intentions of the owner can affect the choice of the capital structure, can affect the composition of your capital structure. Number 12, financial risk level. Too much debt increases bankruptcy risk. If you borrow money too much, you expose your company to the risk of liquidation. Management balances risk with return. That means management will look at the level of financial risk embedded in the capital structure. Management will try to balance risk versus return. We also look at the flexibility. At times, the company will not borrow now. Company will only borrow in an emergency situation. Hence, the company will keep its debt low. You don't try to get to the maximum level. What are we trying to say? For some companies, your article of association may define the amount of debt you can take. For some company, the company's article of association will define the level of borrowing that is allowable. In that case, management will not want to exceed that level. Management will not want to get to that maximum because borrowing can be used in an emergency situation. It is much easier to borrow money than issuing equity. In an emergency situation, you can easily borrow money to meet the emergency. Regulatory factor. One is tax policy. That is, what is the tax policy? If the tax rate is high, the company will prefer debt finance. Lastly is legal / industry requirements. There's what we call industry standard. the amount of debt capital you can issue. Bank is regulated. For banks, they have what we call regulatory capital ratio. The law specifies the amount of equity and debt the bank can use. All right. We need to round up this discussion. If time permits today, well, I'm not so sure we can do it today. To round up tonight's discussion, theories of capital structure. What are we trying to do? Now the question is it wise for a company to borrow money?
Yes, sir.
The question we are trying to unravel here, is it wise? Is it reasonable for a company to borrow money to finance? If the answer is yes, what is the percentage of borrowing a company require? Should we borrow? Should we have 50% equity, 50% debt? Or should the company maintain 60% equity, 40% debt? We are trying to look at it. How should a company construct its capital structure? That takes us to theories of capital structure. There are two main theories that attempted to explain the effect of changes in gearing promise. How do you come about this 30 to 70? There are two main theories that attempted to explain the effects of changes in gearing on the weighted average cost of capital and on share value. There are two main theories that try to explain the impact of changes in gearing on the WACC and on share value. These theories are one, the traditional theory of capital structure, and Modigliani and Miller theory of capital structure. Let's go to this. The traditional theory of capital structure argues that there's an optimal level of gearing. That is, there's an optimal level of capital structure for a company. The traditional theory of capital structure argues that there's an optimal level of capital structure for a company This is the level of gearing. That is the level of borrowing. When we say gearing, it means borrowing. When you say you are geared, you have borrowed money. So please note, if you use the word gearing or leverage, it means the company has borrowed money. The traditional theory says that there's an optimal level of gearing for a company. This is the level of gearing at which the weighted average cost of capital is minimized. That point where your cost of capital is at minimum is your optimal level of capital structure. According to this theory, according to the traditional theory, as gearing increases, that is, the more you borrow money, the more a company borrows money, cost of equity will rise. As a company is borrowing money, the cost of equity rises. However, there is greater proportion of cheaper debt finance. The cost of debt finance is cheaper, and we have more debt finance in the business. Even though cost of equity is rising, cost of debt is falling. In that case, the weighted average cost of capital will continue to fall because we have greater proportion of debt in the capital structure. Hence, your work will continue to fall. It will now get to a point as gearing increases, we get to a point. Your work will now get to the minimum point. Once your work get to the minimum point, that means you have achieved optimal level of capital structure. That is appropriate level of capital structure. That optimal level of capital structure is that level of gearing that minimizes your cost of capital and maximizes your value. In other words, the traditional theory of capital structure concluded that capital structure decision is relevant to the market value of the company. The traditional theory of capital structure concluded that the choice of capital structure decision will affect value of the company. Hence, company must choose wisely. The traditional school is saying that your choice of capital structure will affect your value. Hence, you must choose a capital structure that maximizes your value and minimizes your cost. That is the conclusion of the traditional school. Number 2 theory. Modigliani and Miller theory without taxation. I'm trying to take water. All right. Modigliani and Miller theory without corporate taxation. Modigliani and Miller developed a theory of capital structure to challenge the position of the traditional school. Let me take that again. Modigliani and Miller developed a capital structure model so as to challenge the position of the traditional school, of the traditional theory. They argue that if corporate taxation is ignored, they argue that if we ignore corporate tax, then the level of gearing will not affect value of a company. According to M&M, the choice of capital structure does not affect market value of the company, provided there is no taxation. In other words, you can choose to finance your business with equity, or you can finance your business with debt, or you can finance your business with equity and debt. That will not affect your value, in as much as you are not paying tax. If you like borrow money, if the level of gearing increases, we have greater proportion of cheaper debt finance. Yes, cost of equity will rise as borrowing increases. Cost of debt will fall. As cost of equity is rising, cost of debt is falling. The weighted average cost of capital remain unchanged. Look at the logic. If you borrow more money, cost of equity will rise, cost of debt will fall. Your weighted average cost of capital remain the same. The weighted average cost of capital is the same at all levels of gearing, in as much as the WACC is the same. Value of company will be the same, in as much as WACC is the same. Then value of company will be the same at all levels of gearing. In other words, M&M concluded that on the assumption that there is no tax, on the assumption that company will not pay tax, the level of gearing is irrelevant to the market value of a company. The level of gearing will not affect value of company. Hence, there is no optimal level of gearing a company should try to achieve. You can choose to finance your business the way you like. that will not affect your value. In as much as there is no taxation in the economy. That is the position of the track of Modigliani and Miller without taxation. M&M argument without taxation can be summarized as two propositions. Proposition 1. The weighted average cost of capital of a gears company is the same as the WACC of an ungeared company. Whether your company is geared or your company is not geared, the cost of capital is the same. Please note, WACC represents cost of capital, overall cost of capital. Look at it. The WACC of a geared company, this letter G represents geared, is equal to WACC of an ungeared company. Next, if the WACC is the same, total value of a geared company is the same as total value of an ungeared company. Look at this. Value of geared is equal to value of ungeared, provided there is no taxation. Proposition 2. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. The cost of equity in a geared company is equal to cost of equity of an ungeared company plus financial risk premium. This is defined in formula. KEG, cost of equity of geared, is equal to KEU, cost of equity of ungeared, plus open brackets, KEU, cost of equity of ungeared, minus KD, cost of debt, close brackets, multiplied by value of debt divided by value of equity. You are going to use this model if there is no taxation. Lastly, Modigliani and Miller theory, allowing for corporate taxation. M&M without tax leads to the conclusion that gearing is irrelevant. However, this theory is not true because in the real world, companies will pay tax. The assumption of Modigliani and Miller is not valid in the real world. In the real world, many companies are geared. Modigliani and Miller revise their initial model to include corporate taxation. Modigliani and Miller revised their initial model to include corporate taxation. The inclusion of corporate taxation significantly changed their analysis. The inclusion of corporate taxes significantly changed the analysis. With corporate tax, interest on debt are tax allowable. Interest payable on debt capital is allowable expense. Therefore, Modigliani and Miller concluded that geared fare has advantage over ungeared fare. Emma concluded that geared companies we have advantage over ungeared companies because they pay less tax. Therefore, the value of a geared company, the market value of geared will be greater than the market value of an ungeared company. The cost of capital of a geared company will be lower than the cost of capital of an ungeared company. This is because geared company will enjoy tax relief. The tax relief will be used to reduce cost of capital. Reduction in cost of capital will increase the value of a geared company. So MMM is saying that companies should take advantage of debt capital, borrow more money. By taking more debt, the company will enjoy higher tax relief. This tax relief will be used to reduce the overall cost of capital. The overall cost of capital is the weighted average cost of capital. Hence, the WACC becomes lower when a company is geared. If the WACC becomes lower, value will increase. As your cost is reducing, your value is increasing. Modigliani and Miller therefore reached the conclusion that because of tax relief on interest, there's an optimal level of gearing. Because of tax relief, there's an optimal level of gearing a company should try to achieve. A company should try to make its gearing as high as possible, up to the maximum practicable level. Modigliani and Miller arguments allowing for taxation can be summarized as two propositions. Proposition 1, the work in a gears company is lower than the work in an ungeared company, an all-equity finance company. Look at the formula. The weighted average cost of capital of geared is equal to work of ungeared multiplied by 1 minus dt over d plus e. Your d represents debt, value of debt. Capital letter E represents equity value. Small letter t represents the tax rates. Total value of a gears company is higher than the total value of an ungeared company. The total value of a geared is greater than the total value of an ungeared. The total value of a gears company is equal to total value of an ungeared company plus value of the tax shield. Look at it mathematically. Value of geared is equal to value of ungeared plus dt, debt multiplied by the tax rate. That is what we call the tax shield. Lastly, the cost of equity in a gears company is higher than the cost of equity in an ungeared company. The cost of equity in a gears company is equal to the cost of equity in an ungeared company plus the financial risk premium. You only introduce the tax. Cost of equity of geared is equal to cost of equity of ungeared plus bracket cost of equity of ungeared minus cost of debt, close bracket, multiplied by value of debt over value of equity, multiplied by 1 minus the tax rate. Wow. We are done with the explanation. This is capital structure. We have 15 minutes to round up this class. Let us look at, in 10 minutes, let us look at last diet question, number 4. Deliberately, I share last diet question with the platform. Go check question number 4. Question 4 for 20 marks. Look at it. I'll read. Sun Steel Nigerian PSC is a long-established company engaged in the manufacturing and distribution of building and roofing materials. The company is listed on the Nigerian Exchange Group and has developed a reputation for reliable dividend payments and prudent financial management. Sunsteel owns extensive tangible fixed assets, including modern production plants in Ogun and Delta states, and a nationwide network of warehouses and distribution vehicles. These assets have been largely insured and they are unencumbered. The company currently has the following capital structure. Look at the capital structure. Ordinary shares, 8 billion. Retained earnings, 2 billion. That means total shareholders' fund, ordinary share plus retained earnings, 10 billion. 10% debenture secured, 5 billion. So this company is financed by equity and debt. That means this company is geared. This company is financed by equity shares and debentures. That means Sunsteel Nigerian PSC is a gears company. This structure has remained unchanged. Debt of approximately 45%. The finance director believes that Sunsteel can take additional borrowing to finance, arguing that the gearing is comfortable. So the finance director is saying that their level of gearing is comfortable. However, the board wishes to review the factors that should be considered in determining appropriate capital structure before making any policy changes, requirements, as the company's financial advisor discuss the main practical factors that should be taken into account when determining or reviewing the company's capital structure. Use Sunsteel PSC as an example. 20 marks. Examiner is asking you, what are the factors that determine a company capital structure? Yes, let me hear from you. The line is open. Promise.
Nature of the business.
1, nature of the business. Yes. 2,
Size of the business.
size of the business. So the nature of this company's business. Production and distribution of building and roofing material. So this company nature of business will affect its capital structure. Now let me ask you, do you think the company should borrow more money or not? Based on the nature of the company's business. Yes, Toluwani.
The company should borrow more money.
The company should borrow more money.
Yes.
That is, take more debt financing. All right.
Yes. Yes.
What other factors? Remember, you are dealing with 20 marks. We have mentioned just 2. Nature of the business, size of the
Income.
business. Who
The
is speaking
financial
to us?
leverage of the company. The financial leverage of the company.
The level of company's financial leverage. Thank you. Now let me ask you. Currently, the company has 45% debt to equity. Will you recommend for the company to borrow more money or not? Debt to equity is currently 45%.
Personally, me, I will not, because the means that the company has 45%, the total capital structure, out of the total capital the company have, 45% is already debt. So if it's me personally, I will not advise for it, but let's see.
So, based on the current financial leverage, it is about more. Okay? We have mentioned 3. Financial
Stable
leverage.
income,
What other
sir.
things?
So we didn't get the last
Stable
point.
income.
Last thing you said.
Oh,
Yes.
Sophie,
The line went off at
your
the
line is
time.
working.
It's breaking.
Tolu, how
Right,
is
can you
it?
hear me now?
Okay, I can hear you now. Tosi, please speak.
A stable income, according to the passage, that they've been paying dividend to their shareholder, so it means they have a stable income. They could actually
Okay,
borrow more.
income stability. Any stability will affect the capital structure. That's good. We can go to his.
Okay, so you were saying something about the 45% gearing ratio. So you were answering it. We didn't hear the last part. So if the company should
Okay,
borrow more money or
Matthew,
not.
let me say it. Jeremiah said we should consider level of financial leverage. That the company's level of financial leverage will affect its capital structure. We agree with that. We now ask the question that currently, the company's level of financial leverage is 45%. Based on the question, let's go look at it. Examiner says debt to equity ratio is approximately 45%. And ask a question that based on the current financial gearing, will you recommend for this company to borrow more money? Jeremiah said no, that the company should not borrow more money. What's your opinion, Matthew?
Hello, sir.
Okay.
Hello.
Yes, we are hearing you.
Yeah, the debt to equity ratio is 45%, meaning they are 45% on debt and the other percentage is on equity. So at the moment, I would say they are still running on more of equity compared to debt. So
Okay, they
maybe
still have
that,
more equity compared to debt. Yes, they should
yeah,
borrow more.
yes, that's my own point of view.
You can imagine it now. Examiner is now waiting for an individual view now. That was the question last diet. It's a very good one. She's saying that the company still have more equity than debt. The company can still afford to borrow more. At least equity is still more than debt. Equity is 45. Is that clear, Matthew?
Yes, sir.
So we can go to look at it. What are the factors to be considered? One, your business risk and stability of earnings. Something, the way you are explaining, you are going to relate something as stable earnings, reliable dividends, established business, and essential products. The company can handle more debt because building material demand is steady. People in tough time, people still build house. What about the risk? Construction sector downtime can affect volume. If the construction sector experiences downtime, that can affect volume of sales. So you look at the business risk as well as stability of earnings, asset structure, and collateral availability. Sunsteel owns extensive unencumbered assets, intangible assets that are not encumbered. What is encumbered? It has not been used for loan. Unencumbered, plant, warehouse, vehicles. The company can easily borrow more money. Company can secure more borrowing using this asset as collateral at a good rate. Company can leverage on this before issuing equity. Number 3, cost of capital and tax shield. Current cost of debt is 10%. The current 10% debentures are secured. Debt to equity ratio 45%. Comfortable part director's opinion. Now, what is the tax rate in Nigeria? Tax benefit. The company can take advantage of tax relief and finance the expansion with debt. This 30% tax rate can be used to reduce the cost of borrowing. But you are going to compare cost of new debt versus diluting equity. If you are going to borrow money, new debt, what is the cost of new debt? If you don't want to borrow money, you now want to finance the expansion with equity, what is the dilution? Will the owner be willing to accept dilution? Sunset will consider this. If you are to take new loan, what is the cost of new loan? If you are not taking loan, if you are to finance the expansion with equity, what is the impact of equity on dilution? Number 4 factor, financial flexibility and future needs. The company is planning expansion. That means the company requires funds fast. The debt capacity of the company looks good. The company has only borrowed 5 billion. Equity fund is 10 billion. If you go back to that capital structure, the company has 5 billion borrowing. The shareholders' fund is 10 billion. The company look good with debt capacity, but you must avoid overgearing so as to retain ability to borrow for emergency. Yes, we are saying that some still can borrow money. It look good, but the company must avoid overgearing. The company must retain ability to borrow for emergency purposes. Alternatively, the company can use retained earnings plus new debt. You can use your retained earnings to finance your expansion. Indirectly, we are discussing source of financing. Retained earnings is an equity source of finance. This company retained earnings is 2 billion. This can be used to finance expansion plus new debt. Number 5, I will stop now. Control and dividend policy. That is ownership and control. Reliable dividends are selling point for shareholders. Taking more debt keeps control with the current owners. Issuing equity dilutes ownership. So you are going to balance it. If you are going to take more debt, what is the cost of the new debt? Then you are going to check. Will the new projects generate return above cost of debt? You are going to ask yourself, will the new projects, will the expansion projects generate earnings more than the cost of new debt? If the answer is yes, then you can use leverage. You can borrow more money. If the answer is no, that means return from the expansion is less than the cost of new debt. That expansion is not financially viable. We cannot finance it with debt. I'm going to stop here. It is 11 o'clock. After the class, I'm going to share this material. Please, you are encouraged to go through this. Start reading now. All right, any question, any clarification? May God give us a better understanding. I'll be checking out if there's no question. Toluwani, any question?
No, no questions, sir. Thank you, sir.
All right, let's have a blessed evening. Good night.
Thank you, sir.
Thank
Nice
you,
having
sir.
you again.
Thank you, sir. Good night, sir.
Thank you, sir. Good night, sir.
You don't run.
Good night, all.